Imagine you walk into a profitable bakery at 7 a.m. The ovens are warm, the register is ringing, and the owner drops a line. "I'll sell, but I need a big down payment." What do?
Welcome to Capital Conversations. I'm Glen Gould. Today, we're going to flip that moment from a roadblock into a playbook you can use. If you want lender-ready numbers, negotiation moves that protect your upside, and funding structures that keep your personal cash low, stay with me.
Quick snapshot before we dig in. We'll cover the instruments that make up an acquisition capital stack, how to turn SDE into underwriting-friendly math, the documents that actually matter to lenders, negotiation levers to reduce upfront cash, and 3 concrete capital stack options you can adapt.
I work with founders who want to buy businesses, not just run them.
Here's the kind of deal we'll use as our running example. A neighborhood bakery with $400,000 in seller's discretionary earnings. Solid margins, loyal local customers. Your job is to take it from steady to scaled without writing a huge personal check.
First, the menu of building blocks. Think of the capital stack like layers. SBA 7A or bank term loans as the base, seller notes to bridge gaps, mezzanine or subordinated debt for stretch, seller rollover equity to align incentives, and earnouts to push a portion of price into future performance.
SBA 7A is usually your anchor. It offers long amortization and attractive rates compared with short-term bridge debt.
But you're asking, what do they actually want to see? Short answer, clean, consistent cash flow and documentation that proves it. When SBA or bank financing doesn't cover the full purchase price, seller financing is the classic bridge. Seller notes commonly cover 10 to 30% and can be structured as amortizing notes or subordinated notes with a balloon. Negotiate recourse limits and cash flow contingent payments so you don't get stuck on day one. Mezzanine or subordinated debt sits behind senior loans, but before rollover equity. It costs more, yes, but it reduces dilution. Use it only when your projections are conservative and stress-tested. Rollover equity is one of the most powerful levers. If the seller keeps 10 to 30%, you lower upfront cash, align incentives, and lenders breathe easier because the seller has skin in the game. Important detail. Negotiate liquidation preferences and vesting so that the seller earns value from real growth, not from one-time accounting adjustments. Be specific. Earnouts push price into the future and tie payment to measurable targets, revenue, gross margin, or EBITDA. They're perfect when buyer and seller disagree on upside. But vague earnouts, they become litigation fodder. Be surgical about metrics and reporting cadence.
Now, let's translate this into lender-friendly math. Lenders care about coverage ratios, DSCR, debt to EBITDA, and historical SDE for small owner-operated companies.
SDE is your friend because it normalizes owner salaries, add-backs, and one-off expenses so the underwriter sees sustainable cash flow. Use it in your model and be conservative about add-backs.
Back to the bakery. With $400K SDE and conservative assumptions, an SBA-backed structure could underwrite 65 to 80% of the purchase price. Layer in a seller note and rollover, and your personal cash could drop into the 10 to 15% range. That's the practical outcome, not a theory.
Packaging matters. Lenders will ask for 3 years of tax returns and P&Ls, current balance sheets, a year-to-date operating statement, rent and lease information, personal returns, and credit reports. They also want a transition plan that names key staff and how revenue will be preserved. Run your own conservative model first. Play devil's advocate. What if revenue falls 10 to 20%? What if synergies take 6 months? Show that downside to the lender. That conservative stress case increases approval odds. Negotiation levers you'll use again and again. Stretch senior amortization. Ask for interest-only periods on stretch debt. Insist seller notes limit recourse, and tie earnouts to verifiable KPIs. Wherever possible, prefer escrow for indemnities over broad personal guarantees. You might think that sounds risky. Fair point. Here's how I protect against it. Conservative covenants, reserve accounts for working capital, and waterfall payment structures that prioritize operating liquidity. Those 3 moves keep debt service realistic.
Now for the red flags. First, over-leveraging. If debt service eats most operating cash, you lose runway. Second, optimistic projections that assume instant customer retention or synergies. Third, assignment issues. Leases or vendor contracts requiring third-party consent can stop a deal cold.
Due diligence highlights: payroll and tax filings, customer concentration, supplier contracts, lease assignability, liens or litigation, and a quality of earnings review. Bring in a CPA and a commercial attorney for these spots. They're where hidden liabilities hide.
Before I give you 3 ready-to-use stacks, a quick deal math sanity check. Always size debt so the business covers debt service with a cushion. Aim for a DSCR above 1.25x in your stress case. If you can't hit that without unrealistic assumptions, renegotiate terms or walk.
Okay, 3 practical capital stacks you can adapt. Option A, SBA heavy. SBA 7A, 65 to 75%. Seller note 15%. Rollover 10%. Option B, balanced. Bank term 50%. Mezzanine 20%. Seller note 15%. Rollover 15%. Option C, minimum cash. SBA 50%. Seller note 25%. Earnout covering the remaining 25% over 2 years tied to revenue targets.
Each option trades cost, control, and timeline differently. Choose the one that matches your tolerance for dilution and your operational plan for the first 12 months.
Action steps you can take tomorrow. Run a conservative 3-scenario model for your target. Gather 3 years of financials and your personal returns. Call an SBA-savvy lender and a CPA, and draft a seller financing term sheet that limits recourse.
If it sounds like a lot, good. Deals are complex, but the payoff is that you can buy growth rather than build every brick yourself. One smartly structured acquisition will scale faster than bootstrapping alone.
If this episode helped, subscribe to Capital Conversations in your podcast app now. We'll follow up with term sheet templates and sample spreadsheets you can use on your next deal. Thank you for joining me on Capital Conversations. I hope today's playbook gives you a clearer path to acquisition without unnecessary personal risk. Keep building. Let's talk capital. Until our next conversation.